How are you today? I already know.
It's
Just
actually
what's that? What was that? Starting off with the Dow Jones, we came and bounced off of this old pivot point. Oh, but look at that. It's the old high, the triple top. So it's pretty crucial. If it can't stay above that, probably be going down for a little while. The instability, or I should say, lack of certainty within the U.S. markets right now is, it's playing itself through. I would say, based off of the fact that this low here, like, look at this. This was a pretty significant level here, this realm, and we went below that.
that
So,
was nice.
yeah.
How you highlighted that.
Oh, this.
That that was excellent. That makes it so obvious what you're talking about.
Okay, good. That little circle is a little bit like it's good because it helps. It follows the cursor, but I was noticing that actually, and then there's this one.
Oh, like that too.
Yeah, and then there's this where it zooms in.
Oh, that's fantastic.
Yeah.
That will be very, very helpful.
Mouse Pro. Okay, so yeah, this coming down right there, that's lower than here. So that's not a good sign for the markets. Now, I'm quite surprised that we just didn't crash, but you know, they've got they've got things under control. Oil, however, they do not. That is button up against these highs and on its way up. It was on Friday where, so in here, this area here, that was where the institutions started shorting oil. So they are in a bad position already. And because it's gone up, created a new high above the area of consolidation, likely not to come back down. Analysts are saying it's going to be probably $200 a barrel by the end of July.
July.
So, what is that? April, May, June, July? 3 months, 4 months? We got to be ready for that. Uh, but there's a plus side to that. You see, I've been talking about it for a long time that the U.S. dollar has been used for as the world reserve currency for so many years that people are so accustomed to energy prices being denominated in dollars worldwide. Even nations would conduct energy deals with the US dollar. But as we've been talking about, the US dollar is no longer the world reserve currency. It lost that status at the beginning of 2022, back when everybody was super distracted by the convoy. Nobody was paying attention to that time. Even there were people in the freedom-minded community, freedom industrial complex, more like, who said that who were talking about how good it was that Epoch Times was still reporting the news. Yeah, guess what they were reporting the weekend that the convoy started? The Epoch Times reported on front page that Putin recognized the sovereignty of the eastern provinces of Ukraine. Nobody paid attention to how that all unfolded over the period of 8 years that it did. Nobody asked, how was it that they became sovereign? How was it that they were recognized as their own independent nation? Oh, I noticed you're all blurry there.
Oh, there I am. I'm back.
That was a little strange.
Yeah.
So, there you have it. That's oil. US dollar against the Japanese yen. Also, yen losing a lot of value. It's come back from a retracement from last. This was on Sunday. Market open. Friday was where it reached that high. It's down a 0.5% from where it was, but it's creating another new high. Now, that's not the all time high. All time high is back here, July 2024. Let's just go out on the weekly chart here and just double check. Oh, yeah, no, that was even higher there back in May of 2002. Let's mark that. But we're getting close. Oh, yeah. We're getting. Oh, no, that was not it. That was not the high. That was this support here. Yeah, okay. So we are approaching that all time high on the US Japanese yen. When this breaks out, it's going to be pandemonium. So we might still see some more consolidation. As we can tell by the trend line, that energy buildup may continue as it rides along this line here. So we'll see.
What is the Japanese yen pegged to?
Well, it's valued by, its indexes, the indices of its stock market. The Asian markets dictate a lot of the Asian currencies' value based
Oh,
off
okay.
what companies are part of that index.
Because as I understand, Canada is based off of the US dollar. Is that
Correct.
correct?
That's
Okay.
right. Yep. The yen is actually more so evaluated with the euro worldwide. We look at
Oh,
it from a U.S. perspective, but typically speaking, this is actually where we get where we derive its value. And as you can tell, that is actually just outside of just under all time highs. So this is how many yen does it take to get 1 euro. So this here is, probably more so a judge of its value. Well, I don't want to say more so a judge of its value. We look at the U.S. yen simply because we're familiar with the U.S. But this energy buildup very well may continue with the euro yen the way that it is. It could break out right now. There's no question about it. It can happen anytime. I would say that if oil is going to go up the way that they're saying it is over the next little while, this will not stay here long. It will break out and it'll be pandemonium from there on out. Japanese markets, this is the Nikkei, coming back to rest at old time highs here, but going underneath, dipping underneath. So because it's dipped underneath, that is not a good sign for the currency. Again, creating lower lows all the time. Those lower lows, combining that with the pressure from above, we can see that is, look at that. Look at how that trend line just continued all the way from there. So highs are getting lower, lows are getting lower. Oh, and I think I went back to regular. I did. And remember, as oil goes up, this is going to really start to go down because Japan is going to have to buy all kinds of oil, which makes everything more expensive, which contracts the market. Less people are spending money, which will bring down the markets. Amazon maintaining its position here above these pivot points. And they're kind of more scattered because they're stocks and they're not currencies. Here's Oracle maintaining its position in the upper half of its consolidation. Google dropping fairly hard here, even though they've been coming out with some new innovations in AI. But we'll see if it can hold this. If it drops down, it'll probably come down to find some support around 254, maybe in the $250 range. I'm just going to go ahead and draw another zone here. We'll be watching for that movement next. If it can hold this, probably see another couple bounces before it takes back off again, but it would have to hold here for us to see that. Palantir, looking like it's possible. It could definitely survive this and go up another bit. I think that we'll see another influx here before the end when it gets finally transitioned into something else. However, these lows right there, that's lower than this low. So it's going to have to be about whether or not it can maintain this as a support.
Would you draw that lovely pink line from that low to that other one?
This one here?
Yeah.
I don't know if that pink line is going to do so well because I don't know if I can get it. Like, that's not really it. I'll draw an actual line here.
Because what you're saying, like, I would have to super zoom in to really see what's.
Yeah, it's a little bit tough. It's so close. It's tough to say.
Yeah. I see it now. I see it now.
It's super tight.
Yeah, but the fact of the matter is that it went there.
Yeah, it did go there. So we'll see. This coming up high is a good sign. The fact that it did go up higher than this pivot point. Oh, no, it did not. Huh. It's basically met it. Again, its stocks got to be a little bit more forgiving with some of this price action on stocks. Nvidia, though, it is definitely coming down towards lows we haven't seen since September. If it can't maintain that, it'll drop. Probably come back to 147 or so. Again, some of these companies like Nvidia is a part now of the US 30, right? Top 30 companies. Well, Nvidia is the #1 company in the world right now, so it's definitely part of the top 30. I think Amazon and Oracle are up in there as well, Google. So the tech stocks are now a part of this whole thing. And this drop here, this has resulted in a $5 trillion loss. $5 trillion loss.
What was the time frame on that loss?
Well, since the Epstein files were the most predominant algorithmic topic, that is 48 days. Yeah. And let's just also look at where we at with gold and silver, because it's not like it barely moved from 10.04 down to 10.09. We'll see what the update is today here. We've been, so we go US 30 45,364 today. Divide that by the price of gold at 45.24. Yeah, 10.02. So it's gone down. It's gone down, yep, and it makes sense that the price of gold, or like how much gold it would take, would also go down. Makes sense. 45,364 divided by silver, 70.3. 645. So it's dropping. It's getting cheaper all the time. So the amplification, so there's already a loss, right? 10%, but then there's also a loss on gold. Not much, you know, that's 2%. 2% loss against gold as well. But that amplifies this, right? That amplifies that loss. Yeah, we're at the hair's breadth, it seems. Silver prices still consolidating after that last dip that we saw that did a heavy test against this trend line. We'll see what happens. There's a second line to be paying attention to here, which could very well provide a little bit more energy buildup. This is on the 4-hour chart, so it wouldn't take long. This is the end of the week here. So if it gets to here without breaking out, I'll be surprised, but we'll see. We'll see. It's a hurry up and wait situation. Gold still consolidating since that last dip as well, but maintaining a tighter grip simply because it's not as volatile. Gold-silver ratio still consolidating, breaking out of that trend line below, which is a positive sign for the ratio. It'll be very difficult for it to get back up, and if it creates another high, I'd be very surprised. Going into the cryptos, we see Bitcoin dominance still at the lower end of this range. Major support here at that 58% line. I'm going to go ahead and create another line here so we can follow that. Yeah. If it can't hold on to that, we'll probably see it test the next level around 57-ish. There's a pivot point right below there at 57.7. But that once we start to drop down, like this next drop in dominance will likely result in, well, obviously it means mathematically that there's more money going into the alts. Price action wise, we are below a trend line right now. And it could just be a strong test. That's something to be mindful of. It could be just a strong test that we're seeing this week. But that this low, these lows getting higher, these highs getting higher, that is a good sign. There is a very strong trend line coming from above, though. I'm going to go ahead and delete that old one. Going into Ethereum, underneath this trend line here from February, but basically just consolidating still from in this range. Midnight, experiencing some droppage here over the last 3 days. 16% drop. But still holding its own there at this 4.5 cent range. We're going to be seeing some major action come out of this here in the next little while, simply because today is the day that it went live on mainnet. You could always buy the tokens, but now smart contracts can be validated on chain. So you can do more than just buy the coin. Now you can actually give it some what do they call utilization. ADA dipping down here just over the weekend to some lows that we haven't seen for a while. 23.25 cents. Sitting underneath this pivot point. I'm going to have to go back in time to before the price action was over here. That's probably back on the weekly chart. Yep. I have to come back here and redraw the pivot lines so that we can follow it if it goes down. Keep in mind, though, that as much as we've gone down here, we still haven't broken past C. We're waiting We're waiting to see what happens. This ABC currently is still the structure on that weekly chart. XRP on the weekly chart. Let's go to the daily. Consolidating similarly to Ethereum. BitTensor actually showing the most strength out of all of the altcoins at the moment. Getting up a leg up above this old pivot line. It's got a good solid leg on that. Next challenge will be this long-term trend line. Fetch showing some strength against the rest of the market right now. It's not like it's got itself a new high. It's got a ways to go there. But the fact that it's been holding its own and not dropping like the other coins have done. ADA dropped. XRP dropped. Polygon dropped. Fetch and BitTensor showing some life. Desync still consolidating. We did see this nice little shot of life coming through January. Sitting at some lows. Boy, oh boy, that chart looks healthy. Coming back. 3,000% is a recovery. 3,000%.
Wow.
Clearpool also at some long time lows. Looking at 2,600% in recovery. That'll be easy. Once this takes off, Beam, video gaming, ecosystem, 2,300% recovery. And you know that's what you got to do when you're looking at these charts and you recognize where we're headed in this data sphere. You look at recovery. You don't look at how low it's going. You look at how much does it take to bring it back to where it was when it got started, or where it was when there was hype, right? There's low hype right now. It's nothing but fear in the market. But that's who you buy from. You buy from the fearful, and then you sell to the greedy later on. That's 4,200%. Let's just take a look at this. Superverse. I drew this line, this red line, because when we first got started with all of this in June of 2024, here it is. You know, we had that go up, and it didn't even go to the all-time high. It just went up. We got all excited because it was up 154%. Should have sold. But I'll be that as it may. When we got this, the valuation was showing that, you know, if we experienced the same thing that we did in 2021 with the alt season, which is where this got started, by the way. This got started at the end of, just before alt season hit its high. But based on how other coins performed in the last alt season, where we got this coin was, it was projected to be 25x, conservatively 25x from that location. So to do that, we got to scale down and we measure that good old stick. So 25x, that's a $20 coin now. $20. But we're not there anymore. That was where we got started analyzing this. So if it goes to $20 from here, yeah, we say recovery is awesome because recovery is 3,800%. Recovery. But that's not $20. That's just the all-time high of $4.73. So if we project that out and say, okay, let's say they're still projected to do that 25x from where they were before. That's a 19,000%. 191x. Because it's the video gaming world. NPC not showing much strength here. At the same time, it's not showing strength going against the trend line, but the highs are getting higher, lows are getting higher. Likely to see some consolidation, a little bit of energy buildup. I think meme coins are going to be leading the way. We'll see kind of like that shot across the bow, letting us know that alt season is here when we see the altcoins take off. Simply because the way these guys are just, they're fanatics. Absolute zealots for the industry, zealots for the technology. 700% just to recovery on SPX. And that says a lot too. Like when you take a look at Superverse from where we started in June of 2024, 2024, down 87%. SPX, same time frame. Let's go to June. Oh no, we didn't even start this in June, did we? Yeah. Only down 71%. Now, it seems big, but it's not as much as the other coins. And the reason why is because they haven't stopped being evangelists. It's almost like this community doesn't feel the fear. Yeah, it's a meme coin, but money's money. And since we all know that money is really just a figment of our imagination, belief, they believe in something. They believe in something and there's money in there. So that's it. That's market analysis on our watch list for the time being.
Lovely.
Any questions?
Well, I've already asked my questions. So this is, as you said, hurry up and wait.
Yeah. It's been almost, I think, probably about 6 months since I started saying we can't look at timelines. We have to look at event lines. Yeah, the war started, and there's still some insecurity of what's going on. Even yesterday when I was meeting up with the Authentic Media Association, nobody is saying anything about current events because nobody can believe anything about the current events. Yeah, I've said that before. I always wait to see what it is. What is it that I don't see it in my watch list right now. I got to get that back up. That's a nice mountain.
Yeah.
What a stump.
I'm coming to the place, or I'm at the place where the stuff that I see in my Telegram and Facebook and whatever else comes, even my email, very suspicious. Very suspicious. Show me how I can validate this for myself. There's been several times in one of my Telegram groups where they're like, oh, yay, President Trump has signed this order for med beds and blah, blah, blah. And so I go to the White House website that is related to these executive orders. And the number that is given on the Telegram has nothing to do with med beds, nothing at all. It is an executive order, but it's for something completely unrelated.
Else. Yeah.
And so I put in my contrary remarks. It's like, look, people, you can't just wait for the savior to come. You can't. I mean, after all this time, it's like Nasera Jacera. If that was actually going to be something, it would have been instituted a decade ago or more. But it's not.
No.
So stop waiting.
Well, and that goes to show just how much people just look at the headlines and they don't actually go and actually read anything, right? Oh, executive order, blah, 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 med beds, yay. You didn't even read the executive order, did you?
Yep. Have to be so discerning and know exactly who you're getting your information through.
Yeah. This would be a good article. I actually haven't read this one yet, so let's do it together. More people are talking about private credit. Surely, the many headlines coming day after day about funds denying their investors' requests to cash out resonate more with a larger audience. Hence, deserve more visibility in media, hungry to attract engagement and maximize advertising revenues compared to all the warnings a few people like myself last time with, there's the title there, private credit, made about it over many years when people did not care so much. Isn't that interesting? It's like now it's a problem. It wasn't a problem before, but now it is. However, this massive problem, not surprisingly, is still being downplayed and sugar-coated. My goal today is to provide you with a better understanding of the real scale of this monster, what the hell private credit really is, and what the real nature of the problems impacting the market is, and how to put yourself in a safe place to avoid the incoming greater financial crisis when the 10-meter tsunami waves ultimately hit the shores. What is private credit? How big is it? Private credit is essentially a form of lending that happens outside of the traditional banking system. Private loans. When a business needs to borrow money, it normally goes to a bank. But today, there's this massive pool of money from large investors like insurance companies, pension funds, HNWI, I'm not sure what that is, family offices. It acts as a shadow bank. These groups lend money directly to companies without going through a bank's strict regulatory process. In terms of size, this market has exploded over the past decade, and now estimated to be worth over $3 trillion globally. Private credit is beginning to look like the bond market, and that comes with red flags, he says, making it one of the biggest, fastest growing corners of the financial world, larger than some well-known markets like high-yield corporate bonds. To give you an idea, at its peak in 2005 to 6, the subprime mortgages market's total size reached 1.3 trillion. We watched The Big Short. When he was making these calls and saying this is going to crash, he was 3 years early. He was looking at the subprime mortgages, knowing that those people would not be able to maintain their payments if the rates went up.
Yep.
Knowing that eventually these were going to become delinquent. Within private credit, there are 5 categories of investments: direct lending, funds led directly to medium-sized companies, usually taking the safest spot in the company's debt pile, which aims to deliver steady income with less risk. These are going to be established businesses. They've already got some capital, they've got some cash flow, but they're wanting to expand. They're wanting to be able to, maybe add another manufacturing facility or something like that to be able to serve more customers. Junior capital. This sits lower in the repayment order, offering higher returns to compensate for the higher risk. Includes mezzanine debt, second lien loans, and preferred equity. And this is going to be like companies that are building a business and they've got lots of volume, but they're already at a high debt threshold and they need a payday loan. That would actually might be distressed debt. Hang on. Involves buying loans of companies in trouble. Oh, okay. Yeah. This would be, we'll help you out, but now you owe us, like a loan shark. And working to turn the business around. So now it's like a vested interest in seeing, I'm loaning you money to get you out of debt. It's a bailout, but now I'm involved in the company. Specialized field tends to boom during economic downturns when opportunities arise. Special situations. In this category, we find anything out of the ordinary, like financing a merger, a spin-off, or a complex corporate event where custom lending solutions are needed. And then asset-based finance. This is a form of lending secured by tangible assets, such as real estate, aircraft, equipment, or even pools of receivables like credit card payments, car loans, or buy now, pay later loans, using those assets as primary source of repayment. What's the real nature of the private credit problems? It might sound simplistic to you, but these are the 5 main problems of private credit. Liquidity. Once the capital is deployed into funds that then lend that money, investors are locked in and they need to wait for the loan's repayment to withdraw their capital. Leverage. Many private credit funds borrowed from banks. The reason why regulators are now starting to freak out in order to boost their promised returns even to senior tranches. Oh yeah, we heard about tranches is what pronounced. Lack of a secondary market. This means there's no transparent way to sell loans under stress, which can freeze the system, trigger panic withdrawals. That is already happening, with Ares being the latest fund on a now large list of funds dealing with the problem. High risk concentration. Private credit funds often bet big on a few companies or sectors, so a handful of defaults can ripple through the tightly interconnected network of investors and lenders. So it's like you might not even be in something that is not paying back, but you're in a network of investors. Everybody suffers. Asset quality. Private credit funds, mostly lent to companies or against asset collateral banks, would not touch even with a 10-foot pole, from already highly levered companies to companies running questionable businesses, for example, First Brands or Tricolor. From subprime credit card loans to even more subprime buy now pay later credit used to fund even essential purchases like food. Coho, by the way, the money that they make, the most money that they make is actually through that, because you can get like a, get a $250 loan for $50. As in, we'll give you the $250 now, and it'll. How does that work? Yeah, I can't remember how that is. It's been a long time since I had to use that, but that it's something that happens. Oh, I need to quickly get groceries because payday's not yet for another 4 days, and I don't mind losing $50 in order to get food now. That is where Coho makes most of their money. While on one side, the change in regulation after the 2008 disaster was meant to avoid a subprime crisis from happening again. Yeah, right. Paradoxically, the very same regulation had several important loopholes that not only have been massively exploited, but made the problem even bigger. Imagine that. And harder to monitor. So, you know how a bunch of people made money last time? Well, it's fine that we crashed the markets, but we don't like how much money people made when we crashed the market. So we got to make it a little bit more invisible. The first huge loophole exploited is the shift from a mark-to-market accounting of all banks' assets to the possibility of not marking to market assets if the bank planned to hold them until maturity. Hilarious. A problem I warned about for the first time more than 2 years ago. Albeit I wrongly assumed that after the 2023 U.S. regional banking crisis and Credit Suisse implosion, so Swiss Bank, the regulators would have closed this loophole. Regulators, and this is where I kind of feel like he's not fully on board with how corrupt the system is. Regulators get cash bonuses from the corporations that want to exploit. Oh, just quickly write this into a bill.
Would you go back to that bank-to-bank bit? Because it didn't quite land.
This one?
Yeah.
So after the 2008 disaster, we watched the Big Short there. It was after that the regulations that they implemented were supposed to avoid that from happening again. Paradoxically, the same regulation had several important loopholes that not only have been massively exploited, but made the problem even bigger and harder to monitor, since it shifted the risks to the obscure shadow banking system. So, in this realm of private credit, is that shadow banking where it's like, yeah, we'll do a credit check, but we're not going to put this on the books with the big banks. You're dealing with me privately now. You want to build a seniors complex as we're locking them away as they're dying off at alarming rates. That kind of stuff. Or, when you're into the shadow banking, that's when high interest loans, or what they call subprime loans.
So what did he mean by bank-to-bank stuff?
The next part here, the mark-to-market counting of all banks' assets.
Yeah.
This one here. Again, this is that direct loan aspect. The exploitation is that they don't mark it down. They don't put it on the books because they don't have to. They don't have to report. That was the loophole in that regulation. Oh yeah, no, you can continue doing private loans, just don't tell us about it. So it's harder for us to see the numbers. The second huge loophole was to allow banks to lend to other financial institutions with limited amounts of capital without properly specifying the quality of the collateral necessary to consider those loans properly secured. So imagine, I've got this lake house, and it's a beautiful lake house. It's $350,000, and I will put that up so that I can get myself a motorhome. So you go to the bank and you tell them this is the place. But the best part about this kind of loan is I don't have to tell them where that lake house is. It could be, helicopter access only. No, it's not worth $350,000. It's worth $30,000. And I'm going to go get a $350,000 motorhome. That's basic. I'm exaggerating, but that's the premise. As a consequence, lending to shadow banks exploded, effectively becoming indirect lending to companies the very same banks would not have considered otherwise. No bank is going to say, "Oh yeah, that's In all honesty, the example that I gave is ridiculous, but only because in a normal circumstance, the bank would be like, "Where is this lake house? Can you give us the legal land description, please, so that we can go and do an assessment on the value of the place," right? Yeah, but the kinds of loans that were being placed, the banks weren't even bothering. It's like, yeah, you know what? We'll give you some credit. It's awesome. And it's going to be 16%. Because that's how they mitigate the risk, right? They just charge more interest. Furthermore, banks successfully lobbied to keep this loophole in place. Remember I told you? Regulators get cash bonuses from the people who do the exploitation. Oh yeah, let's regulate this so it doesn't happen again. To everybody. Avoiding having these assets properly considered under their annual stress rates, even after central banks, starting from the Fed, became aware of the massive risk hidden in this corner of their books. This is the reason last year I warned how Fed stress test reveals how today's Fed is complicit in hiding banks' problems. I remember that article. Last huge problem was virtually no oversight and capital requirement needs for the whole private credit market. which not only allowed all those funds to lend 100% of their funds without putting any reserve aside, but even allowed them to leverage those loans. So we're going to take the debt and then we're going to make promises on it. How to put yourself in a safe place. The whole scale of the private credit risk is not only still broadly unknown, but it's even very hard to track, as the ECB found out in 2024 when it wrote, complex exposures to private equity and credit funds require sophisticated risk management. That's a fancy way of saying this is like a major red flag, and sophisticated risk management just means creative financing to make sure that you can continue doing the laundering for as long as you possibly can. And still did nothing about it. Fancy that. Fast forward today, hilariously, now that the problems are spreading, the very same ECB is freaking out. Oh, ECB to start fresh checks on banks' private credit exposures. So now they're going to be doing credit checks on these old loans that are probably never going to get paid. This example should give you a good idea of how the system is totally unprepared to deal with the private credit implosion. How to protect yourself from incoming financial mayhem that sooner or later will inevitably explode, because the private credit implosion will trigger the greater financial crisis. Yeah, I think he's right on that. It will likely be that the warning, kind of like how meme coins are going to kind of lead the alt season. This will probably lead the full crash, right? We're going to see the contraction of this market simply because, oh no, we're not sending out any more, no more loans. We can't do it. Why? Because we're not collecting on 80% of what we've been doing for the last 14 years, 15 years, whatever. No, it's like 18 years now. The wonder Hitler kicked them out. So, build your cash cushion so you're never forced you are never a forced seller when broader market falls into trouble. For central banks around the globe coordinate again to bail everyone out and reinflate financial asset values back up again. Check your exposure. Now, that cash cushion, I've been telling people, like, get some silver and gold. That's going to be your cash cushion. Check your exposure to private credit funds, BDCs, and any alternative investments that promise high yields with limited liquidity. So just don't go into it. Don't go into the market. Stay out of the market. Doesn't matter, who the best people are. Those people with the little kiosks, little tiny little booths, like sometimes it's just a podium in the malls. Yeah. They've got this, real estate opportunity in a developing zone in Edmonton. Oh, yeah, those are the worst. Wow, I shouldn't say that. You can. But do it when it's like, $5,000 to get into something that's going to sell in 5 years at 50. Don't do it now, though. You're never going to get it. You're not going to see it. Real estate's going to crash, and it won't be coming back for 5 to 10 years. Because this is going to exemplify, it's going to amplify rather another mortgage crisis. Why? Because they can't get the toys to go with the house. Understand, high yields exist for a reason. They compensate you for illiquidity and risk. Yeah, this is risky, but look at the returns. You can make half of what you pay on your credit card if you do this. If a fund is offering 10% with quarterly withdrawals, the math works until it doesn't. Own safe and hard assets directly. Conclusion. Private credit market has ballooned into a $3 trillion plus systemic risk that dwarfs the 2008 subprime crisis. The numbers that we're hearing is 15 times the magnitude. This toxic mix of illiquidity, excessive leverage, poor asset quality, and regulatory blindness has created a shadow banking monster that even central banks don't fully understand. The warning signs are already here. Funds blocking redemptions and regulators scrambling to access exposures they ignored for years. When this unravels, the contagion will spread rapidly through bank exposures to these shadow lenders. Tomorrow, we will cover the next in the series, a lesson from China's middle class. Pay your debts until you can afford to do so. The alternative.
Ooh.
Isn't that a fascinating headline, eh?
Would you post that somewhere? Because I'd like to read that.
Yeah, okay. I'll put it in the telegrams.
My phone, I think it's, I'm losing camera because it's overheating.
Oh. Yeah, that'll be a good article. Looking forward to that one tomorrow. All right. Market analysis. It's Metal Mondays, everyone. Oh yeah, it's blurry again. I'm going to end the stream. Everybody have a good day.
Yeah.